Be Wealthy and Smart, episode 509.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about, are we exiting the bear market? And I bring this up because of all the volatility that we've had recently. People are feeling a little bit on edge. I'm noticing a little more pessimism than we've seen in a while, just according to a casual poll I took in my VIP experience. And it seems like people are not really sure which direction the market's going to go. On the one hand, they're still optimistic. It seems like there's a lot of good things in the works. On the other hand, there was a lot of volatility. There's been technical damage to the charts. People are really concerned that we could be in for a longer-term bear market. So I wanted to share with you an article from MarketWatch written by Mark DeCamber, and he titled it, Dow and S&P 500 are on the brink of exiting a stock market correction. The caption says, the NASDAQ has climbed 12.3% from its Christmas Eve low, but remains in a bear market. And the article says, a new year, a new market. The Dow Jones Industrial Average and the S&P 500 appear in position to exit correction territory if a multi-day rally on risk assets continues apace. The Dow and the S&P 500 marked a fourth straight gain, at least partly attributed to optimism around 3 days of talks intended to resolve a protracted dispute around tariffs between China and the U.S., and growing signs that the Federal Reserve is ready to dial back what has been perceived as an aggressive rate hike path. It was concerns over trade and rising rates and worries that global growth was receding that the U.S. was on the verge of a recession that shattered investor confidence and drove the stock market down from an autumn peak. Anxieties around those matters, however, have subsided somewhat, with the Dow knocking on the door of exiting correction at least by one measure. A correction is usually defined as a drop of at least 10% from a recent peak. Some market technician purists believe that an asset must put in a new high to officially emerge from a correction phase, while Dow Jones's data group views an exit from that phase after it gains 10% from the correction low. The Dow needs to close at or above 23,971.42 cents to emerge from correction by that measure. The S&P 500 would need to climb to 2,586.21 cents or above, according to Dow Jones market data. Thus far, the Dow has climbed 9.57% from its December 24th low, while the S&P 500 has gained 9.95% from that Christmas Eve low, when stocks put in the worst trading action on the trading day before Christmas on record. So I want to pause here for a minute and just comment on that, because we've talked about how you have to stay invested in order to get the big bounces that come after the big moves down. And there you have a Dow bounce of 9.57% from the December 24th low, and an S&P bounce of 9.95% from the Christmas Eve low. Tremendous performance that you would have missed out on had you gone to cash. Had you panicked at the bottom and gone to cash, you would have missed that 10% bounce, a huge amount of performance that you could regain. And that's why you have to stay invested. Even though these declines are very painful, they're very scary, can frighten the heck out of you, you still need to stay invested so you can get the bounces and get back some of the return that was given up in the drop. The article continues on to say, meanwhile, the NASDAQ Composite Index is up 12.3% from its Christmas Eve nadir, but that index remains squarely in bear market territory, usually defined as a decline of at least 20% from a bull market peak. The index would need to climb another 7.7 percentage points to break out of a bear market which it entered on December 21st. All right, I want to pause and just say, okay, so NASDAQ has always been more volatile than the S&P or the Dow. As you know, the Dow is only made up of 30 stocks. The S&P is made up of 500. The NASDAQ has 3,441 stocks in it. So we're looking at a much broader index, but we're also looking at a lot of higher beta stocks. What does that mean? That means more volatility. That means that as the Standard & Poor's 500 moves up, if you have a higher beta, it means that you're going to move up more. And if the S&P moves down, you're going to move down more. So it means it's going to have more volatility in either direction. And NASDAQ has had a lot of technology companies, internet companies, communications, etc. And so these companies tend to be smaller companies that are faster growers and do have more volatility. But the volatility's been on the upside for a while because the market's been going up. Now that we've had volatility on the downside, the NASDAQ is down more than the S&P or the Dow. So yes, it is going to take the NASDAQ a little bit more to make up some of its losses, but it probably can do that a little bit easier because, as I said, it is more volatile. So once the market gets a real strong uptrend going, the NASDAQ will probably outperform whatever that uptrend of the S&P 500 is. The article goes on to say, Wednesday marks NASDAQ's 12th day in bear market, and it would surpass the March 2009 bear market for the NASDAQ, which ran 14 days. That bear market lasted from March 3rd to March 23rd, 2009. March 9th, 2009 was the bear low, according to Dow Jones market data. I want to pause there again. So after all this talk about the March 9th low of 2009, guess what the McClellan oscillator did today? It went from a minus 80, which is super oversold, to a positive 80, which is super overbought, within 2 weeks. And guess when the last time it did that was? Yep, March of 2009, right as we had the bottom of the Great Recession. So could this be an indicator that the bottom is in? Well, it might be, but it also might not be. There's no definite way to see the bottom. However, usually when a market has gone down as much as this market has, it tends to have a bounce and then a retest of the lows. So I'm kind of in the camp that we have to retest the lows before we're sure that we have made a definite bottom. If we retest the lows and the prior lows hold, and then we go on to close higher, chances are we've made a final bottom. If, however, we go down to test the lows and pierce through those lows to a lower low, that could mean that there's more downside to come. The article goes on to say, gains for equities also come as oil futures, viewed as a so-called risk asset like stocks, broke out of a bear market, gaining 20% from their December 24th nadir. Oil and stocks have moved in tandem recently, amid worries about economic expansion throughout the globe contracting, exacerbated by tensions around U.S.-China trade. I want to pause here and say, yes, there is some tension due to U.S.-China trade, but to me, that is not the cause of the bear market. I do think if there is some trade agreement, or I should say when there is some trade agreement announced with China, because I do believe it's forthcoming, I think we could get a huge move up in the markets from that agreement with China. It would mean a lot to both countries. I think essentially what caused this bear market was the aggressiveness of the Federal Reserve, who was talking up interest rates. Just by saying they're going to tighten interest rates, they cause interest rates to anticipate that and move up in ahead of them officially raising rates. So their rhetoric of wanting to increase interest rates 2-3 times made interest rates go up, which can cause markets to go down. When the Fed came back and was a little bit more dovish and said, well, maybe we won't do 2 or 3 more hikes. Maybe we'll do 1 and nothing before May. That's the latest. That gave the market room for rates to come down a little bit and for the market to rally. The article goes on to say, both stocks and oil are approaching trades above their 50-day moving averages, which is seen by some industry participants as a further sign that a bullish trend is trying to reestablish itself. See the chart below. And Bespoke Investment Group, in a Wednesday research report, noted that since World War II, there have only been 12 other declines of 15% or more within the span of 3 months that were immediately followed by a rally of 10% or better in 10 trading days or fewer. So got that? There's only been 12 other declines of 15% or greater within 3 months that were immediately followed by a 10% or more rally within 10 trading days. So this to me is saying that we had a very steep drop and then a very steep dead cat bounce. And it doesn't always bounce that quickly and that steeply. But in this case, it's one of only 12 other times. The article goes on to say, on Wednesday, the release of minutes from the Fed's December rate-setting meeting helped to underline the view that the central bank is no longer in a hurry to raise interest rates, which arguably produced the stiffest headwinds for financial markets. Wall Street, however, may find new worries afoot as a partial government shutdown is set to enter its 19th day and is already the second longest in 40 years. End of article. I will post this article in the show notes and on my website, so you can look at the charts, you can read the full article, you can print it out and keep it if you want, make note of some of the numbers that they talked about, where when the market hits there, the bear market's over. Those are all good things for you to notice. But I just wanted to give you some hope that we may have seen the worst behind us. I do think, though, we have to go down and test to find out if that's true. We are heading into a little bit of resistance. Just looking at the chart of the S&P 500, we're coming up on the 50-day moving average, which will possibly be a level of resistance that we might hit and go down again. If we get through that 50-day moving average, then the 200-day moving average will be the next point of resistance. And if we break through that, then that would be a very positive sign. My sense is that we probably go up and then drop down again, seeing if these lows hold. The best thing to do in this kind of a volatile market is absolutely nothing. This is not unusual in the second year of a presidential election cycle to have this kind of volatility, and it usually gets better in the third and the fourth year of the presidential election cycle. So hang in there, and a couple years from now, if past history is any indicator, this market may be a lot higher than it is now. If you are interested in this kind of investment analysis and would like to get more information about my inner circle called the VIP Experience, send me an email at lpjhome@gmail.com. And join us over on Instagram at instagram.com/Linda P. Jones for more wealth tips and insights and positive encouragement to get to your goals faster. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.